Today, I'm joined by one of the top performing gold companies over the last year. Now, we talk about the health of the capital markets. We talk about good time versus bad time to raise capital if you're a gold miner, when to look for acquisitions versus when to slow down, and how when the iron's hot, it's time to strike. Now, this company has eyes on 500,000 ounces of gold production by 2030. That's the vision. And they think they can get there without diluting shareholders through too many equity financings. The CEO's name is Charles Funk, and the company is Heliostar Metals. Today, we're going to dive into their portfolio of gold assets in Mexico. Enjoy.
This is Jay Martin.
Charles, welcome to the show. It's about time I had you on, man. I'm looking forward to this.
Yeah, thank you very much.
So it's timely that I have you on because last month I host a monthly mastermind session with this program called the Commodity University. It's a bunch of resource investors that are looking for an edge, a suite of courses and instructors, and a monthly mastermind. And every month, myself and a couple other personalities from the space meet, and last month about 50 investors showed up and we talk shop for about 20-30 minutes, and then the group of investors that show up, they actually bring all their deals that they're looking at to the panel. And last month it was myself, Lobo Tigra, and Adrian Day. We kind of share our thoughts on the companies that the investors are looking at. We don't publish this, which allows the panel to be brutally honest with their thoughts and allows the investors to be totally vulnerable, right, about what they're looking at. And Heliostar came up again and again and again. It was a panel favorite and an investor group favorite. So timely that I've got you on the program today to kind of break down what we talked about behind the curtain a month ago and hear it directly from yourself. So here's where I want to start, though. For somebody who is brand new to the Heliostar story and knows nothing, do you have an elevator pitch for us, Charles, just to quickly give us the high-level overview, and then I'm going to start pulling on threads.
Perfect. Yeah, I do. And thankfully, there is a significant shareholder on that panel that you referenced. So I think I know who might have been leading the conversation. So the quick pitch for Heliostar is we're a gold producer who is aspiring to become a 500,000 ounce a year gold producer by the end of the decade. We've got a deep portfolio of development projects. And if we achieve our production goals by 2028, we should be worth multiples of where we are today. And the kicker is we think we can do it with little to no equity dilution from the cash flow that we're generating from our mines and a project financing facility, so that when Ana Paula comes online, we're talking about a significant step up in production at significantly lower costs that drives that re-rate that we'll then see into our share price if we can deliver without the equity dilution.
Yeah, I like how you lead with that, by the way. 500,000 ounces by 2030, that's the mission, right? We'll have to wait and see if you can do it, but I love that it's very clear to you and the team. And I've heard you say that a few times on interviews. And yes, it was Adrian Day who began that conversation, but as mentioned, Heliostar came up from the group a handful of times. Okay, so let's break down the portfolio a little bit, because right now you have 5 assets in Heliostar. 2 are producing, and 3 we could call development stage assets. What you said is there's one of your development stage assets, Ana Paula, will become a producing asset that will help bridge finance you into further production. This is how you're going to prevent dilution of the shareholders. So walk me through, because this is a strategy that you've employed. If I were just to take a step back, Heliostar seems to me like the consequence of a team that stayed very busy and took some tremendous risks when there was no market support or safety net to catch you, right? When a team does that successfully and succeeds, which doesn't always happen, they're often the companies that set the high watermarks when the market returns, right? And that seems to be the track that Heliostar could be on right now, because you guys stayed very busy. You took some tremendous risks when the market didn't favor you for it, and now you're being rewarded. And the journey might just be getting started. So walk me through that origin, though, because this strategy of sort of buying production, bridging future acquisition, you've executed recently. So walk us through this, Charles.
Yeah, we certainly spent a significant period of time unloved. Hated might be too strong, but unloved. To go back to that goal, we think that 500,000 ounce a year producer space is kind of an optimal spot to build a multi-billion-dollar business that's small enough that a small management team can run it, and it's a fun company to work for. And that you've got a lot of optionality. You can buy assets, you can do M&A, you can make discoveries, you can merge. There's different ways that you can create shareholder value. So that's kind of a clear-eyed goal of creating a bigger business. And we started out in 2019. And the project we had in Alaska, a good project, but we weren't big enough for it. We couldn't raise enough money at the right times of the year to do it. And so because we still had that producer mindset, or the mindset that we wanted to be a producer, we were looking at a time and in places that other people weren't. We were new to the relatively new names, had success with Visa, but that's a long way off being a producer. And so we couldn't compete, in Ontario, Quebec, or in Nevada. We had to look off Broadway, and our experience was in Mexico. And so we acquired the Paula project, which is a project that we thought had the potential to have very high margins on a very attractive gold ore body. And we acquired that. And that was, as you said, it was a higher risk technical view that other people hadn't had at a time when the market wasn't, valuing these assets at all, really. We got a bit lucky with our timing buying the remainder of the Argonaut portfolio last year. We bought, 3.2 million ounces current resources, 2.9 historic, that I'm not allowed to add up, for $5 million, or net 15 when you put the two transactions together. So just the simple fact that you paid so little for them tells you that no one wanted them. The gold markets were tough. The jurisdiction was unloved because the president of Mexico was in his peak anti-mining rhetoric, and they looked like they were coming to the end of their mine life because they hadn't had any significant investment in them. So that's what really catapulted us. We knew we had a good project in Paula that we were trying to find a way to unlock, and then getting the cash flow from the assets, and now this tailwind of this gold price has really transformed us such that we're a much lower risk proposition than we ever were. We're not a development story with no funding pathway. We're not a trust me story in terms of these assets can make money. We're now getting quarter in, quarter out production and delivering on that growth pipeline.
Can we walk through asset by asset? And let's start with La Colorada, one of your producing assets. So what are we looking at from production standpoint, Charles? Future outlook for the project? What do we need to know?
Yeah, so the cool thing about the Colorado is we've just put an updated technical report out that covers it. So for those who don't know, the Colorado is a little mine outside of Hermosillo, where I am right now doing this interview. I'll be out there in the morning. It's a project I first visited in 2016. I never dreamt that we'd come back as the owners of it. It was one of Eldorado's first gold mines in the 90s. It built Argonaut in the 2000s. And it's always been a good little mine. It's always averaged about 50,000 ounces, and it's nearly always made money. But the previous owners, Argonaut Gold, were starting to struggle for cash as they were trying to build a mine in Canada. And they stopped reinvesting in the asset. So it came to a logical conclusion from what they saw, and it needed a significant capex to expand the pits that Argonaut didn't make or wasn't prepared to make. Unfortunately for those who followed the Argonaut story, they ended up selling all their assets in pretty tough circumstances during that capex blowout, and we were the beneficiary buying the Mexican assets. So we found low-grade ounces in stockpiles, which we're currently mining. Mm-hmm. About 20,000 ounces of our 30 to 40 guidance range this year is coming from La Colorada. We recognized there was ability to grow the resource, and we grew that by about 60,000 ounces. And we've been able to stage, because we've seen a pathway to get permits in Mexico to get much lower capex. So looking forward, La Colorado's got 6 years of mine life ahead of it, averaging about 50,000 ounces a year. It's fairly lumpy, at about $1,900 all-in sustaining costs. It's been quite an incredible turnaround from an asset that was in care and maintenance when we bought it. And further to that, we still see a lot of exploration upside. It's quite surprising for an asset as mature it is, how little drilling there is. The resources are open. There's some really good exploration targets. So we bedded down production. We've just put out the study to sort of set the resources, and now we're looking forward to upside. I think there's a lot of upside at La Colorada.
And what do you think, Charles? Are you more inclined to say that would lead to an extended mine life, increased annual production? What's the take?
If we find more ounces, absolutely. For example, the resources are open at depth. There's really good underground mine potential beneath the pits that with open intercepts. There's a gold in soil trend for the geos on the call that's above the cutoff grade of the pit, but it's never been drilled. Literally dirt on the ground above the cutoff grade of the pit. We think it might be guiding to a vein underneath. So it's got this very attractive exploration growth that we think has a good potential to extend that mine life.
Okay, yeah, I appreciate that. So La Colorada, that's where you're at right now today. What we can expect is 50,000 ounces per year, all-in sustaining cost around $1,900. And at present, I think it's stated a 6.1-year mine life. You're looking at the exploration upside, and that's the news flow that prospective shareholders should keep an eye out for, I expect. Moving down the line, San Agustin. So it's kind of an interesting one for people who aren't, I guess, versed in like heap leach technology, but walk us through how that project is producing for you right now and how you expect that to shift as you move into 2026.
Yeah, so I think San Agustin, I've said it a few times, is a really underrated asset for multiple reasons. So San Agustin looked like it was about to become a mine closure that has a $20 million closure cost. And it was one of the main reasons why people didn't buy these assets before we did. And so no one wants to buy an asset and then going to have to spend $20 million to shut down and rehabilitate the mine. There was a part of that deposit, though, that required a permit. So whilst we were waiting for that permit, we were doing something called residual leaching, and we continue to do that, where you've stacked all the gold on the leach pad, you put a solution through that leach pad that dissolves the gold into liquid, that goes down and hits the glorified pool liner at the bottom, drains out into a pond of liquid gold. You run that through an absorption circuit, which is a fancy way of saying charcoal, and that sucks the gold back out. And then you can heat up and separate the gold from the carbon and pour gold bars like you see in videos and movies. And so that takes a long lag time, anywhere from a few months to a few years before that exhausts. So incredibly, San Agustin hasn't been mining now for 12 months, but still been making good money for us as a company. That's about to change. We were able to get the permits and the permissions to expand into what we call the corner area at San Agustin. By end of this month, at the absolute latest, we'll be back crushing and stacking, and we'll see that gold coming out of the leach pad by the end of the year. So San Agustin will be back in production in about 6 weeks from now. It's got a 14-month mine life. It doesn't have a long mine life. We had the discipline that we weren't going to spend money on it until we knew that we could mine it. And so now we're looking to expand that. We'll see how long we can grow that mine life. But at today's gold price, our recent study says, yes, it will make about $65 million on the corner area all next year. It's incredible free cash flow generation. We think we can make between 100 and 150 million in free cash flow over the next 2 years from San Agustin and La Colorada.
Okay, got it. Yeah, that's interesting. The mine hasn't been in production for 12 months, but because of the lag in the leaching process, you're actually still extracting gold. And I think you said, did you say within 6 weeks you expect to be back in production at San Agustin?
Correct.
Did I hear that?
So the first pad should go on the material in about 12, 13 days from now. Okay. You should see the first gold through that about a month later. So we think we might be in line for a nice Christmas present from Durango.
Okay, got it. And at present, your production is kind of split relatively half and half between La Colorada and San Agustin. Is that correct?
Yeah, top end of the guidance, it's the 40,000 half. At the bottom end of the guidance is 10,000 residual leaching and 10 from the restart. So we'll be kind of in bottom to mid end of the range because we are about 6 weeks behind where we thought we would be at San Agustin. So yeah, somewhere in the realm of 2/3, 1/3, I think is more appropriate as the year goes on. You're right in what you've read in our guidance. Next year, that'll switch to being slightly stronger at San Agustin.
Yeah, got it. Okay. And Q2 earnings, by the way, were 14.3 million off of those projects. Correct?
Correct. We're very shortly about to put our Q3 earnings out. We're generating strong operating cash flow. We're using that money to spend on development and things like Ana Paula. So to be clear, strong operating cash flow.
All right. No, I appreciate that. I wanted to start with the two producing assets. And then let's just get back to Ana Paula. We touched on this at the front end of the conversation, but we're a feasibility study in progress right now. If things go to plan, you're expecting to be in production in 2028. And I think La Colorada, you said $1,900 AISC. Ana Paula is around 1,000 or 1,011, something like this. It's a very low cost mine. So walk us through what you know at this point, because pre-feas is now completed, correct? And feasibility.
So it's a bit unusual. So the history, and it's a good chance to explain, that history. So there was a PFS on an open pit at Ana Paula. I think it was 2017. We updated it as we had to when we bought it in the beginning of 23. It was permitted to be an open pit, but we bought it with a very different view in mind, that the high-grade core of Ana Paula was something special, and you've already got to the punchline with the 1,011 all-in sustaining cost telling you that. So what Ana Paula is this giant sea of low-grade, globally about 2 million ounces, with this spectacular high-grade core in the centre that makes up the bit over 750 M&I, just over 500 inferred that we have today. And so when we bought it, we didn't have a lot of cash. The market was tough. We did the drilling that we could, and we always wanted to do a lot more, but we had a lot of inferred ounces. So we've just put out a PEA that includes the M&I and inferred, but we're in the middle of a 15 to 20,000 metre drill program that's going to convert those across for the FS. So we're going directly from a PEA to an FS in early 27 to achieve that timeline of commercial production in 28.
Got it. Okay, so going straight to a bankable feasibility study, and currently drilling 15,000 meters of drilling in progress to upgrade the confidence level of that resource. Yes. Okay.
Correct. So we've got the reason we did it as a PEA was so we could include those inferred ounces. We had success in 2023 converting inferred to M&I, and we know we just need to do more drilling. We're highly confident about our ability to convert a lot of those inferred ounces, and so there's 3 rigs right now doing that. We should wrap that program up early next year, and that's going to be the reserve that drives the feasibility study.
Okay. So am I right to say with the existing portfolio at Heliostar, if things go to plan, you're on pace to produce around 300,000 ounces per year with what you've currently got eyes on? Is this correct?
Organically from our portfolio. And so, yes, we by the end of the decade, we'll have La Colorada up to a few years around 100,000 ounces. Ana Paula's first 4 years averages 130,000 ounces.
Okay.
And then we also got, almost for free in the asset portfolio, an asset called Saratoga. We've treated Saratoga as historic because we had so much on our plate. We just delayed that in terms of disclosure. This quarter, we're putting a PFS out on Saratoga. The last study, again to repeat, which is historic, was a 2.9 million ounce deposit at 0.5 grams per tonne gold equivalent. At a $1,350 gold price. We're very much looking forward to putting that updated study out. At these gold price environment, we think that can sing. And so our plan is to use the cash flow from the existing assets to build Ana Paula, and then the cash flow from Ana Paula to build Saratoga. So we can get 2/3 of the way to our goal at the end of this decade with assets that we own 100% of, which is quite incredible for a company our size.
And off of existing portfolio cash flow?
Correct, which is pretty unique. Now, I'm never saying that, we've always reserved the right to issue equity if it can grow resources or grow production, but we're going to do everything in our power to get Ana Paula online without doing that, because that'd be an incredible feather in our cap if we could achieve it. And more importantly, it'd be incredibly beneficial for our shareholders. The comparison companies doing 150 to 200,000 ounces at, sub $1,500 all-in sustaining costs are $2 billion companies. That's 4x where we are today. And if we can get there without issuing a share, then you can read through what that could do to our share price.
Yeah, okay. Got it. So Saratoga, PFS in progress, targeting 80 to 100,000 ounces per year. You mentioned
Yeah, the
2.9.
PFS will have about 80 for 15. I think ultimately we would like to design a study that crunches the time down and the ounces up.
I see.
So I think when so this PFS looks to be similar in terms of the previous one, but ultimately I think it can be a 100,000 ounce a year producer if we make some changes in a follow-up step.
Okay, presently 2.9 million ounces. That's in the M&I category for Saratoga. And that's the bridge, the process that we kind of opened up with that I wanted you to share on, one asset bridging the build of the next, that asset bridging the build of the next, preventing your shareholders from dilution. You've always got that option, right? If market looks right for you to hit the street with an equity financing, you've got a strong portfolio and a pitch to do so, but you've got an option here, right, to avoid that. Okay, so
yeah, I think philosophically, it's interesting on how you build modern gold companies. Historically, you could build a lot of mines quickly. That's a lot tougher to do, and so most people, if they want to move quickly, buy things. Normally, you're buying things that are higher cost. They're coming to the end of their mine life. They're not fit for purpose for someone who owns them. So typically, you sort of grow quickly today. Most companies are doing it with higher all-in sustaining costs. But the only way to truly get low all-in sustaining costs is to build new mines that have the best years in front of them. So you've really got to kind of, in my belief, tic-tac-toe between that. You don't want to be so slow that you're only building a mine every 10 years, but you need to balance getting size and critical mass with being able to bring new mines into production that give you the opportunity to have industry-leading costs. And that's, we want to go, you should not buy Heliostar today for 30 to 40,000 ounces of production. You should buy us, and you can hear the Canadian in my accent, so bear with me, to where the puck is heading. And so where we're heading is a much higher quality, much more sustainable producer in the midterm that we think we can get to without any material dilution. And I think that's why you should buy a Heliostar share, that journey from scrappy and hard and high risk to quality and sustainable and with a track record of performance.
Can I ask you, you opened up here with your 2030 mission, 500,000 ounces per year. Why that mission? Why that number? Where did that come from, Charles?
I think there's two answers to that. There's a simple answer that is a multi-billion-dollar company that, as I said at the start, and I worked for a similar company like this in Australia called Oxiana, Oz Minerals at BHP bought, that was small enough to be nimble and creative. So you're really in that sweet spot. You're both predator and prey. If markets are tough, you can survive by yourself. If markets are on, you've got, discovery or deals move the needle. So that's sort of the high level. There is a slightly deeper level to that as well, in the sense that it comes back to my technical background in geology, in that, most gold companies over the last 10 years before this market came, say prior to 2023, got bigger because ETFs forced them to get bigger because they were the only bid in town from sort of 2013 to 2020 into 2022, say. And so that led to all the major companies. I'm talking about the Barrick Randgold, Agnico growing, Newmont Goldcorp, Newmont Newcrest, to want only mines that can produce 250,000 ounces a year. Most gold mines don't start at that rate. They start around that 50 to 150,000 ounce a year rate. And the good districts grow and the poor districts get smaller. And so philosophically, we think if we bought about 5 mines doing 100,000 ounces a year, 500,000 ounces, we'd probably get one call wrong. We'd probably be around the mark on another couple of those. And then 2 or 3 of those, because of what we think is our technical advantage in recognizing good deposits, could be materially better and we could grow with as a company. So there was actually a scientific aspect to the strategy that there's not a lot of 250,000 ounce a year ore bodies out there. And most gold companies have grown from not doing huge debt burden on assets that fit where most of the gold deposits do start. And then we'd see where we went from there. So a high-level business view and a slightly more detailed technical view on why we targeted that.
Can you share, and it might be, I'm not sure if you can, but is there a bigger vision? So 2030, very clear, right? And I feel like you've got a lot of the puzzle pieces in place, and we covered those today. We've got eyes on the first 300,000 mission is for $500,000, 2030, and you've been applying this strategy. Now, some of this might have been opportunistic with the portfolio you've got today, but beyond that, what's the ambition with Heliostar? Stay in Mexico, look for more opportunities like you've got, broaden the scope. What's your take, Charles?
Yeah, I think there's two aspects there. So our bigger vision is actually around, what would you call it? Technical excellence and respect. We actually want to build a company that we're proud to work for. That's truly our bigger vision as a company, where people are proud to say, there's certain companies in this industry that when you mention their name, there's an implied credibility. And so internally, what we talk about amongst ourselves is, can we reach those standards where people see our name and assume that that means good standard work, good decision making, real discipline, as a management group and as a group of employees. So that's what our bigger vision is. If we execute, that can have many ways that it manifests over the next 5, 10, 15 years. We're certainly here for multiple decades in the industry, and we want to grow ourselves as management and then grow our companies. In terms of the M&A question, there's a lot of M&A ideas getting sent across our plate at the moment. We've sort of stayed out of a lot of those for the reasons that you stated. There's not many good development projects as good as Paula. So why take on the M&A risk when you've already got a really high quality development project? We would love to have another 100,000 ounce a year producer, 200,000 ounce a year producer to help get us to the goal that we said. But right now they're pretty expensive. So we haven't seen any opportunities there that make sense. We've looked at the odd thing, but we've got this incredible luxury that we've got this really strong organic pipeline of the next 2 mines this company's going to build underway. So we look at that from a position of strength. If we were to do something, I think anytime you buy an asset, you're normally paying fair value for what is there, but we would be buying it for something we see beyond that. So I expect us to do something that's, off Broadway, a bit like what we've done in the past, not necessarily the most obvious to the banking and finance sector of our industry, something that we formed a technical opinion on that could be better than what we're paying for. We ultimately do want to grow, and I think we're likely to grow over a 5, 10, 15-year period outside of Mexico. But we love being in Mexico, and it's always going to be a core part of our business. So we're never going to be one of these companies that starts in Mexico and leaves. Mexico will always be a key part of our business. And if we find the next good project technically in Mexico or out, it doesn't matter to us as long as it's a good project technically.
And if anybody wants to get like a visual boots on the ground experience inside this portfolio, Charles did an excellent series with Jamie Keach, Resource Insider. Check it out on YouTube. I think there's 3 episodes out and the 4th one coming. But Jamie was down in Mexico with Charles and the team walking the projects and just getting inside each of the assets. Really well done, by the way. Jamie's great.
Yeah, Jamie's done a great job. I'm proud of the way it shows our team. It's a great chance to show, it's you and I talking now, but there's a lot more people in Heliostar, and it's a great way to show that.
Yeah, very cool. In terms of news flow that people should look out for, prospective shareholders, existing ones, Q3 earnings will be right around the corner. Look forward to the feasibility study on Paula. Do we have an expectation on the date there, Charles? Can we eyes on that?
Yeah, so we think it'll be like Q1 27 is the likely time for that. So we think we'll have the permit back, the financing organised, and the feasibility study in Q1 to make a construction decision.
Then to make the construction decision. Okay, got it. And a PFS in progress right now on Saratoga. As well as drill results from Paula, obviously spinning right now, so we can expect some updates there.
It's a great mix. It's it's steady state production showing cash generation. It's deployment of that cash into studies, creating a lot more value in the assets and demonstrating to the market the value in the assets, with the next of those being the Saratoga study. And then, the real power of this gold price, both the production that we found, which I think's the skill of our team, and the gold price, which is an incredible tailwind, which we accept our good fortune for, has meant that we've got the cash flow. We're drilling 15 to 20,000 meters at Paula. We're drilling 5 to 10,000 meters at San Agustin. We'll end up with about 20,000 meters at the Colorado this year. So there's a lot of drill result news flow coming that we funded. It's quite cool to be able to be doing all those at once. Whereas if the market wasn't like this will be a lot slower and a lot more phased. We can push hard and move fast, which we like to as a company, because we got the cash to do it.
Yeah. And you got the assets that you collected when the market wasn't there. So you got lots to work on as well. You're not out shopping right now, right?
Correct. No, it's, I pinch myself at how good we knew it was the right time to buy assets. I had no idea it was this good. I think there's a lot of our peers out there or competitors who would kill for the pipeline that we have.
Yeah. Well, you had a great quote in that series with Jamie, actually. You talked about just everybody knows, you should buy the assets when the market's in the gutter. The problem is there's no capital available to do it, right? It's like
that's a hard learnt lesson, that one. God, it was tough raising the money for Paula. But the perverse benefit of that is you end up with incredible shareholders. It allows me to give a plug to Adrian, since you mentioned. The guys who came into that financing, including Franklin Templeton, Adrian Day, Eric Sprott, are the best of shareholders. And so the only people left at the bottom of the market were very strong, long-term people who back company builders, and they've been incredible supporters along the journey. So we've benefited strongly from the shareholders we got, but it was very tough work.
Yeah, no doubt. And they're big positions. I think Eric Sprott has 15% of the company, Adrian Day, 8%, Franklin Templeton, 11%, something like this.
We'd not be here having this conversation today without, the foresight of people to put bigger checks up than they reasonably should have on a lot of trust that our vision for these assets were right. And it's been quite gratifying to date. There's still a lot more to go, but it's quite gratifying to date that we've been able to, vest their confidence in us.
Yeah, man. A lot more to go. Okay. Well, look, let's leave it at a lot more to go. Charles, it's been great, hearing the breakdown from you. Love to get you back on, Q1 2026, get an update on how things are materializing and keep everybody up to speed. Congrats. I'm sure there's a lot of people slapping you in the back now. I kid with some entrepreneur friends of mine. If you grind really hard at a project for a very long time and make the sacrifices and the gambles, and eventually you succeed, right? You get there, you cross the line, right? Whatever that might look like on whatever project you're working on. If you win, right, eventually you hear the line from somebody, the inevitable line where they look at you and they say, oh, it must be nice. It must be nice to have such a great portfolio of assets, Charles. Must be nice, and you remember the journey and you're like, well, it's nice today, right? Where were you in the last 5 years?
We recognize we've come a long way quickly, and it's on the back of the team and our supporters, which we've touched on, but we have a long way to go. We have a very aggressive, bold vision for the company, and we feel like we're in the very earliest of innings, if I'm going to push my North American sporting cliches, of what Heliostar is ultimately going to become.
Yeah, great, man. Okay. Well, I appreciate this, Charles. Great update. Congrats. Look forward to the next one. And I'll be seeing you soon in Vancouver.
We'll definitely follow up. Thanks, Jay.